All right. My name is Chris Campbell. I'm a practicing CPA and I work with small businesses and individuals to help them pay the least amount of taxes possible by keeping them out of jail. So, today I want to talk a little bit about a way to save a little bit on interest and penalties. So, when you're filing your taxes, and this is really, especially for those that are self employed, when you file your taxes and if you don't pay enough taxes, and whether this be on the corporate side or individual side. I see it a lot more so on the individual side, but even on the corporate side, in those instances where you do have to pay the taxes, whether that be to a state or the IRS on the corporate side, if you don't, the taxing authority likes you to pay what you owe over the course of the year. They don't like it when you are paying your full taxes that you may owe at the end of the year. And especially more so, it can be problematic if you're self-employed, right? Where because you're not having taxes withheld from your check, you're not having taxes withheld from your income. It's your responsibility to determine how much you owe and make those payments. So, with that said, if you don't pay enough over the course of the year, you do get hit with interest and penalties for not paying enough over the course of the year. And it's not a lot, but nonetheless, it is determined based upon how much you owe. So if you owe a lot, and obviously that penalty is a bit higher. Now, the way though it's calculated, and this is how I'm saving. So the way that this penalty is calculated, the taxing authorities assume that your income is earned evenly over the course of the year. So the way that they calculate those penalties, they are expecting you to pay in quarterly installments. So for every quarter that you don't pay, you get penalized. And the way that the tax authorities assume it is that you are earning this income evenly over the course of the year, which might be the case for a situation if you are a W-2 employee, you get a salary, and usually that salary is earned evenly over the course of the year. However, for those that are self-employed or in business, I'm sure as you know, the income is never really even, right? So unless you're operating as a contractor, you have a steady contractor payment. That's one thing. But for those that are operating businesses, most know that income is not earned evenly over the course of the year. You have your high seasons, your low seasons, income fluctuates. Business goes up, your business goes down. Unexpected things happen. Seasonal things happen. But whatever the case may be, that income is rarely generated evenly over the course of the year. So coming back to that, with that said, you can wind up in a situation where that can be problematic for this particular penalty because the IRS or the authorities are expecting you to pay quarterly payments. But if your income is uneven, you don't want to make payments on money that you haven't received yet, especially if you're in a situation where you receive a lot of income at the end of the year. So I do have a couple of self-employed clients where they get busy on holiday season, end of the year, and then make a good chunk of income in that last quarter or those last few months of the year. But when you're reporting your taxes, they don't look at it by each quarter. They just look at your performance for the course of the year, over the course of those 12 months. But if you're in a situation where you earned a lot of that income over the latter part of the year, you can accumulate quite a few dollars in this penalty because the taxing authority assumes that you should be paying this dollar amount evenly over the course of the year. For those that do earn a chunk of money towards the end of the year, one way that you can bring this penalty down is applying for what's called the annualized income exception. And again, this is very helpful for those who have income that fluctuates heavily over the course of the year. Because again, this not paying enough penalty assumes that you've earned this income evenly over the course of the year. Now, if you apply for this annualized income exemption, you can actually trace out and segregate your income that you've earned over the course of the year. And you can show the IRS or the taxing authority that you've generated different levels of income in different periods of time. And once you're able to do that and map that out, that should drastically reduce your penalties because you can show that, hey, I didn't really make as much. I know that I might have made an income of $300,000, but 70% of that income was in quarter four, right? So if that's the case, you shouldn't be penalized for not making enough payments on that 300,000 in quarter one. So this method allows you to show that you've made a lot less money annualized for the first part of the year, and then show when you made that lump sum at the end of the year. So by doing this, because the penalty is calculated by each quarter, you can reduce the penalty on those calculations if you would have such penalties, because you can let the IRS know the fluctuation of your income. And then that way your penalty will be recorded and adjusted accordingly if you wind up owing it all. So this could be a good way to save some money if you're either self-employed and your income fluctuates, or I see this a lot with folks who receive bonuses. So if you are a W-2 employee and you receive large bonuses, this is another category of taxpayer where this would be useful if you receive a large bonus during the course of the year. And depending upon the industry or the company, bonuses usually happen at the end of the year or at the beginning of the year. If you're in, say, finance, or if you're in big law, when those bonuses hit, sometimes those bonuses are anywhere from 50% of your salary up to 2 times your initial base salary. So this definitely presents a situation where your withholdings over the course of the year are out of whack, where it's just not equal. And yeah, I also see a number of those sorts of taxpayers usually wind up owing, mainly because of their bonuses, and it throws all of their withholdings out of whack, and then they wind up owing, and then they get hit with this penalty because they didn't pay enough over the course of the year. And more than likely they were, but a majority of that income was tied up in the bonus, right? You get your bonus either in Q1 or Q4. So there was no need to make these additional payments for those other quarters you did get bonus. So that's a good method to use. The way that you can record this, if you're self-employed, you have your company, this can all be traced through your books. So just make sure that you have accurate books, and we can work that out. That can be worked out through tracking your revenue through the course of the year. And if you're a W-2 employee, just save your stubs throughout the course of the year and present those stubs, because they normally have year-to-date figures on there. So if you look at it over the course of the year, you can look at those year-to-date numbers over the course of the year to determine what the levels of income were. And then you can use that to report to the IRS or whatever taxing authority to show your fluctuation of income, and in turn, reduce that penalty for failure to pay over the course of the year. So it can save you a few dollars. So that's all for now. I hope this was helpful. If you have any more questions about this topic or any other tax or account related questions, feel free to reach out. I'm happy to help. All right. That's all for now, and I'll talk to you in the next one.